You are in the global family office group. These are wealthy people. How are they dealing with the volatility in the market?
Well, most of all, Greg, they want to earn a positive real return, greater than inflation. As you well know, family offices are sophisticated investors. They're very institutional in their approach, just happen to be taxable. So coming into this year, they were prepared for a slower market, for a slower growth, higher inflation, more volatility. And so they position their portfolios accordingly. We can run more defensive, more alternative investments, hedge funds, private equity, etc. And many of the concerns from last year are less this year. Things like supply chain, not as big a concern. And they're getting a better understanding of the inflation, the sticky inflation that we have now, and the central bank response. So they're getting around to a better understanding of that. What's been a concern this year has been cybersecurity, interestingly. And then secondly, taxes have been a big issue this year as well.
Well, wealthy people tend to pay a lot of taxes, at least they should. So what are you observing from the tax front?
No surprise here, Greg. Wealthy investors want to minimize their taxes. But we have observed a couple of trends. This year, more than ever, we've had a massive revenue increase at the government level, both at the federal and state level. In fact, some states have even gone into surplus category. What's good for the government, however, has not been great for clients because they're having to pay a massive amount of taxes for gains from last year, even as the markets have gone down this year. And so it's a big issue for clients and having to face the cost front and center. And so the issue of after-tax returns has really picked up steam, particularly interest in tax-managed equity type of solutions.
So can you talk about your tax-managed equity strategy, how you deal with that for those wealthy folks?
Sure. Tax-managed equity strategies, or some people like to refer it as TME for short. It's really just an ETF that mimics the underlying index, but then in addition generates active losses within the portfolio that the clients can use elsewhere in the portfolio. So this time of year, we see a lot of tax loss selling from investors, but the TME process is a year-long process where the portfolio manager actively buys and sells stocks in the portfolio to generate those losses.
Why can't investors do it for themselves? Because I'm sure they can manage those losses.
They sure could, and they should. Everybody should be realizing losses, minimizing taxes. However, when you have multiple accounts, as a lot of our ultra-high net worth investors, family offices do, many moving pieces, it becomes much more difficult to coordinate all the trading and as well stick to the index and your benchmark for the portfolio. And that's where a systematic tax-managed strategy tailored to your goals, to your risk parameters, and your loss budget makes more sense.
Finally, one big moving piece is Washington. We have midterms coming up. Can you talk about how any changes in Washington and the makeup of the Congress, for example, might affect your tax-managed equity strategy?
Well, two aspects. I'd say our clients certainly don't expect a tax cut anytime soon. But then secondly, we expect continued volatility in the markets and more muted returns. And in that type of an environment, the TME strategy or tax managed solutions are able to add a lot of excess performance to clients. And so that's why there's a lot of interest, a lot of activity, and a lot of pickup in this space.
All right, well, thanks a lot for coming on and talking about it.
Thank you.